we have our next presenter coming up here today. I ran 1 minute over. Um, a good friend of mine, Guillermo Bauder, for clarity on asset management. He's going to be presenting today on emerging market debt. Guillermo, are you on the line with us? Okay, I believe Guillermo is on the line. We just have to unmute him.
Okay, sorry for that. I'm here.
So, hi, Guillermo. I'm going to stop sharing my presentation and allow you to project your presentation. Are you ready to do that?
Yes.
Okay, go ahead, go for it.
Okay. Is that on already? Are you on? Yeah. Can you see my presentation, Mike?
That's perfect. I can see your presentation. Thank you,
Okay.
Guillermo.
Well, first of all, thank you for inviting me. Thank you all who are connecting today to share a few moments with me. My name is Guillermo Bauder. The idea today is to cross through global emerging market bonds and short term of time, but I'll try to produce a quick outlook of what's going on and where we can see some opportunities. Here are some of the topics that we're going to be covering today. The history, very quickly, the history of the market, why emerging market debt, some challenges ahead, risks and opportunities, why an active management strategy at this point in time, an example of an investment case, the investment process, and why actively manage strategies or funds versus benchmarks or ETFs in the current scenario that we're navigating, okay? I started my career as a trader for a bank in 1992, trading Brady bonds at the time. Currently, I manage over $100 million. I manage a global emerging market fixed income fund that invests only in dollar denominated debt for the last 4 years. We have over 40 clients and an experienced team that is fully dedicated to this asset class. Just to very quickly tell you a little bit about the market. That market started a long time ago, but emerging markets basically started in 1989 when Brady bonds were created after the Latin American countries defaulted. These bonds ended maturing around 2003, 2007. By this time, there was a significant spread compression, which provided a fantastic opportunity for companies in emerging markets to start tapping more intensively the markets and using this as an alternative fund of sourcing. Since then, the market has been growing dramatically, and we expect it will continue to grow even more. Today, there's over 4 trillion bonds outstanding, dollar-denominated debt, issued from near 100 countries, in around 70 sectors, and from more than 2,000 companies. So it's a pretty interesting marketplace. You have top sectors today being banks, the sovereigns, real estate, financials, oil and gas, metals, utilities, etc. The top issuers being Brazil, China, Mexico. Markets started developing more in Brazil at the beginning, but then China has been taking over in the last few years, and we expect this trend to continue to grow. Today, the market represents a fraction of the US market, but in terms of GDP is relatively similar. So we expect there's growth coming forward in this marketplace. After the 2008 crisis and the European crisis, a lot of negative debt has hit the market. We expect the situation to maintain itself. We can even see more negative debt coming forward if the scenario were to deteriorate. So this generates a situation where our market space gets well bidded, okay? In today's world, we are facing a lot of challenges ahead. It is very special times we're living into for a macro manager. I would say everybody's facing the second wave of coronavirus. Nobody really knows what the effects will be, how the economies are going to open up, how the people are going to react to this certain situation. So there's a lot of uncertainty going on here. Then there's default raising risk. Today, markets are expecting something like 10-15% default rates for the next 12 months. So you have significant risk there. It was going to be important to navigate firmly through the scenario. Then, to complicate matters a little more, you have a US presidential election this year, which has always been a source of volatility. Then we are facing a US-China trade war, which had already generated a lot of stress. And with COVID originating in China, the situation just got worse. So a lot of uncertainty coming from this place in the future. As we can imagine, the recovery will be uneven in different countries and different sectors because of their capacities and their metrics. And as these deteriorations happen in these countries, also political risks will be increasing. So we have a landscape there that is really challenging going forward. And last but not least, you still have the Brexit situation, which needs to be dealt with and see the real effects of that. So as mentioned earlier, here we see a chart where S&P is projecting a 12% rate of default for US high grade speculative bonds. Globals are around 8.5, and we don't have the data for emerging market, but we expect this to be something in between the 10 and the 15% range. So as mentioned earlier, we have very challenging times going forward. Okay. Also, the COVID presented a situation where all countries have had to have a fiscal response, but their capacities are different. So you can see here a chart where, for example, Brazil has had a strong reaction in the fiscal front, but the loss of GDP is dramatic. So you can see it varies from country to country. It's not a stable effect all across. You see, for example, South Korea has done a relatively moderate fiscal response, and they're also having a very small loss of GDP. So this is a very complicated scenario going forward, which will be providing a lot of opportunities as well. So this is not necessarily bad. It will generate opportunity for smart money looking into it. Here's a little bit of an easier maybe form to see some of the points. For example, COVID management. You see that apparently some places like China managed it relatively well versus Brazil, where we have a huge amount of death. Then their fiscal standing point. You have some countries in Asia where they're standing relatively well. In Latin America, doesn't seem to be standing that well. Then in the monetary front, they all seem to be aligned, all active pretty actively within their capacities. Then low oil price impact. You have some countries which benefit from lower prices of oil, like the Asian economies, and some countries which suffer from low oil prices, like MENA and Latin America, some of Latin American countries. Then you have independent challenges that each of these countries are going to be facing. For example, Argentina is facing a very delicate debt restructuring situation. China has also an important debt burden that they're carrying from the 2008 crisis, and so forth. Each of these countries is going to be dealing with their situation. For 2020, you can see the growth forecast is pretty negative. So markets are pricing in a very steep downside here. But the interesting to see is that the forecast for the 2021 growth scenario seems to be very positive. Okay, so markets seem to be pricing this in. You're seeing markets expecting a very strong 2020, or let's say a lost year, but then a strong recovery going forward. So this is very interesting. So when we're looking at things, we're looking at investors, at our investors, at our investments towards the end of 2020. Okay. Here you also can see a chart as how it varies when you go from sector to sector. So for example, you see on the left-hand corner, telecommunications and utilities and pharmas are having a relatively mild impact, versus on the right upper side, you see transportation, oil and gas, gaming having a dramatic effect. So it will change from sector to sector dramatically. Okay, so this is also challenging, but also an opportunity in order to take advantage of situations in the stress area over here, where we can maybe find good companies that will survive. Here is a chart that gives a little bit of the view of how this market has evolved through time and the different crises and how it has been recovered. So you can see here in this space where we're standing here that we suffered a steep decline, but the market has recovered a good part of the drawdown. So markets are here in this point here, asking themselves, is this going to be a V-shaped recovery? Is it going to be a W-shaped recovery? There's a lot of uncertainty over that. The Fed and the governments have been very quick to react this time around, providing an immense amount of liquidity that seems to be supporting markets. But it is unknown if even with that we might face some short-term correction as the scenario becomes clear and people start going out. But looks like it will be an opportunity to enter anyway at these levels. Here you can see a little bit of the past. So in the 2008 crisis, although it's a very different crisis from the one we're facing today, where you have had a loss of supply and demand effect simultaneously. This only happened after the Second World War. But anyway, this 2008 chart shows how corporate debt dropped around 16%. And then 2009, they recovered around 34%, 35%. Then 2010, they recovered another 13%. So what happens is here, if companies take a hit, but they have sound businesses, sound balance sheets, and they recover, and they start showing investors that they will survive and that their paying capacities are stabilizing, markets tend to trade up and investors have a fantastic gain. Even though the equity holders might be losing money, bond holders have a nice carry and the bonds will trade back to par or even above par. So what are we seeing in today's market? On one side, we're looking at a scenario where inflation is expected to be very low, and then on the other side, we have yields looking to be low for a longer time. The recent dot plot from the Fed indicated that interest rates might be near zero all the way through 2022. There have also been talks about yield curve control, where the Fed will be buying treasuries in order to maintain yields on the low side. There's also the alternative of negative interest rate debt, which the Fed openly said it is not considerate, but it still remains as a tool that you can use in case there's a lot of distress. We saw that in Europe, as I mentioned earlier. So there's a lot of support for monetary policy withholding the hand of the market in order to provide liquidity and try to bring the market back to stabilization as soon as possible. So it's not all bad news. For example, you can see here in the commodities space, you can see the first graph shows the loss of demand we suffered from on oil and the impact this had in prices. But as you look forward, as economies start to reopen, you see the projected growth of demand and the impact this will be having on prices, and production is lagging. Okay, so By production lag in demand, you would hopefully have a, a better pricing for oil, which would generate better pricing for many companies in this exposure. Also, as industrial activity is looking to pick up with economies opening up, you can see here the commodity index is also starting to turn into positive ground. So you have some signs that we can look forward and positively towards this reopening. There's still uncertainty of how is it going to be, which sectors are going to perform better or worse, but we still seem to be walking towards a better scenario, okay? Um, Here you can see the average yield differential spread between emerging markets high yield and US high yield. So you can see there has always been a spread, even through the crisis, the spread was there, but then the spread widened as investors were favoring US high yield versus emerging markets on several weaknesses they were seeing in emerging markets, only to normalize afterwards with central banks actions and the TARP normalization effect, okay, closing back the spread to a more normal situation. So what I'm trying to show here is that markets are trying to normalize, and this is good. And even though emerging markets is a more challenging scenario, we are seeing some normality coming back to the market. Here you can see how yields spiked in the last crisis in 2008, and slowly how they started trading back to very low levels as quantitative easing started hitting the market and low interest rates had an effect of bringing back demand of bonds and company financing themselves at lower rates. Same thing happened here so far, where you see yields spiking on an extreme liquidity crash, let's say, and then slowly as the markets, as the Fed and governments have been intervening with liquidity, this spread have been compressing. As I said, this is a different crisis, so we cannot assume in a straight line that we're going to be going back 100% to these levels, but we can definitely think that with the Fed and other central banks around the world being supportive of lower yields in order to provide cheap financing for government and companies, that there's going to be a search for yield, and as things normalize, this line here is going to probably look towards going to back to levels of 2018, 2010, showing us that we have around a 500 basis points spread compression on the making in the next few years. Okay, so this is a very bullish scenario. So how do we play on this scenario? One of the effects would be to earn alpha. There are many ways, but one way would be to earn alpha looking at this sector here, which is the investment grade space, which is under a negative watch currently. You have $158 billion of debt on negative outlook or negative watch. Once these investment grade bonds lose their investment grade, there is a huge amount of investors that are obliged to invest only investment grade, which will trade out in applying a negative price action to the bonds, which provides a fantastic opportunity for investors which are not obliged to maintain investment grade investments only. So this is a very healthy space to navigate within the scenario of so many uncertainties. Okay, you can see here how this is a table for the rate of default from Standards and Poor's. You can see here for investment grade, the risk of default is around 2.64, and it goes all the way up to 3.5, but it is a small hike in rate of default compared to the yield that you acquire. So investor can acquire maybe 200, 300 basis points extra by jumping into this space, and in its area that is very well supported, okay? So we are looking currently to find the best risk reward mix of opportunities within emerging market global bond universe. Some of them lie in the BB plus credits, as I just explained, given that many institutionals will invest in investment grade. There's a risk relation return between triple B minus and BB plus. So the yield increase significantly in the BB plus, but the risk doesn't necessarily increase proportionally. Okay, and this is an interesting inefficiency to the market provided by the excess liquidity on one side, which is the investment grade, and the extreme lower liquidity on the high yield side. Okay, but when these BB credits are upgraded and they become triple B, then they have access to a huge pool of liquidity on investors overnight, which pushes prices significantly up. Okay, so in a scenario where you have treasury yields very low and trading is, investment grade bonds are trading very tight to treasuries, some investors might be searching for opportunities, and you could think that the BB plus space could be the first level they will go in order to find the extra yield they need. And this will be very supportive for this BB plus space, okay? Just one second. So these credits on the BB space also could benefit relatively well in most case scenarios, okay? As they have financial strength, lower leverage, but also moderate yields. So if in case there is a risk persists, you will still have good demand for these papers, okay? So how do we do our investment process? This is a macro play, so usually it's a top-down situation. So we're going to be looking at the global macro around the world, the country macro, the geopolitics, the sector, then go deeply into credit analysis, and then make our final decision to invest or not. But then there's also opportunistic situations where there's a company, a specific event that will pop up in our radar, where you would have a bottom-up approach. So we go into the credit analysis, understand the credit, the situation that is generating the distress, then the sector, how it's looking, their outlook, how does it look going forward? Is this company going to survive or not, or how they're going to behave? Then the geopolitics and the country, and then finally take the decision. So we can do investments both ways, okay? In this scenario with such level of uncertainties by country, sector, and credits, I believe it is very healthy to have an active management approach, which can be provided by funds or managed accounts, okay? So here you can compare the Clarion Fund against the JP Morgan index for sovereign debt and the JP Morgan corporate bond debt. And in this slide, we can compare the Clarion Fund over time against the major ETFs in the market space. Okay, we are all the way around here. So I believe, as I said, with so many challenges ahead, it will be important to avoid some countries, some sectors, some companies, and this can generate a smoother ride across a very complicated minefield we have ahead of us. Okay. A company is set up by an investment committee where the main participants are myself as a portfolio manager, Gabriel, my partner, is the chief strategist. Arturo, my brother, has also been working with me for a long time, helps us in everything from research to support on every other front. Our team is also formed by 2 credit analysts who help us do company summaries, credit initiation studies, liquidity analysis, recovery value studies, and we go basically all across the credit research that is needed. In fact, we can also count. We also count with a trader who controls the portfolio and who can also helps us execute all the ideas that we have, plus an administration team. Okay, so this is more or less an intro to the market and to the asset class and what to expect going forward. I don't know if you have some questions. I think we have a little bit of time still. Arturo,
yeah. So
do you have any questions for any participant?
Here we have a few questions here. I'm gonna start with how do you generate alpha?
Well, a way that we can generate alpha is as I said, we can find a country that have, let's say, complicated complicated dynamics, complicated metrics, and search for a good company with good quality metrics that is going to overpass the dynamics of the country. And a good example for that could be, for example, the case of Brazil, which has complicated metrics, and then the case for Petrobras, where it has good metrics in a difficult sector, but which will hopefully pull through positively through time.
We received another question here earlier, which reads, which is the debt level of the company you hold, and you think they will burn cash in the next 12 to 18 months?
Well, that's a complicated question and very diverse. We have companies in the whole spectrum, so from the investment grade to the lower tier of credit investments, so the changes a lot from one to one. Maybe what I could show you is we have done, for example, stress tests during when this pandemic started. So here we see, for example, the BBB rated companies. So we did a stress test for all the companies where we took out, let's say, 6 months of EBITDA, plus the cash flow, plus their trading lines, short-term debt and interest expense, and see what was the coverage level. So we see here that most of the investment grade credits will come out very healthy in this situation. Then the situation for BB credits, you have a more mixed situation where some companies are having a more difficult time, okay, where you see that the coverage level of their obligation, for example, for this company is not as good. So they're going to probably, if they were to face a 6-month loss of EBITDA, which hopefully we're not going to be facing something like that, they are going to have to go and increase their liquidity. Many companies are moving and increasing liquidity levels dramatically. There has been a record tapping of the markets recently. So many companies have already solved the situations. You have other companies, for example, in the BB case, like Teva, which has a very healthy situation, and they can withstand a loss of 6-month EBITDA very nicely. Then if you move to the single B rated area, the situation gets more complicated. For example, this is one of the most delicate credits that we have in our investments in POR. So this company loses, for example, used to lose around $100 million per year. Now they're going to be losing something like $200 million per year. And as you can see, their short-term obligations versus their cash and their lines of credits was insufficient to cover their debt. So they had to go into negotiating new debt with the bank and restructuring. Finally, they managed to improve their debt profile by doing a debt deal for around $900 million, which basically pushed maturities to 2023, 24, giving them a very nice waiver. Okay, this was probably possible based that they have a strong shareholder with very good relationship with the banks, and they had also free assets that they could use because their total balance sheet was on all their assets was free. They had a covenant in their bond where they said that they can only use up to 12.5% of the assets to pledge it to get extra debt. So at the end of the day, they ended doing this and the situation is stabilized. So it changes from company to company, and we try to understand this dynamic and see the opportunities. Okay.
I'm getting a lot some more questions here, Guillermo. How do you manage risk, or what's your risk mitigation strategy, and how you protect downside risk?
Okay.
Guys, I have to interject. If you don't mind taking that one question and then wrapping up, I would appreciate it.
All right.
Okay, I'll try to respond quickly, and then you can contact me by email, and I'll be gladly available to respond on your questions. So in terms of managing risk, one important thing is not to be forced into selling assets in a drawdown. So we will try to have a cash position in these current times, or have access to very liquid positions that we can drop very quickly and increase our cash positions. Also have a well-diversified portfolio with some very good quality bonds in very short duration, mixed with some bonds in the middle of the spectrum, and mixed with some bonds in the longer duration, which will probably be exiting very quickly. So it's important that we have a lot of liquidity in this space, and that we react very quickly to market downturns. But in the current scenario, we are navigating with a moderate or conservative approach, given that there's so many risks out there, and there's a possibility of a second wave of COVID with some sort of a correction. Okay. So, well, I would like to thank you for this opportunity, and my apologies for taking up most of the time, but please feel free to contact me via email, and I will be glad to answer all of your questions.
Guillermo, Arturo, thank you guys, both of you, for sharing this information with our group. It was very well organized and thought out. I really appreciate the way you took a macro top-down view as well as a bottom-up view to express your best investment ideas. And we'll be making a copy of this presentation, of course, with your permission, available to all the attendees today. So please do send us a copy. And as we edit the video, we'll post it on our Flyer website for any of the people on today's call that requested the presentation and recording. So thank you guys, and we wish you the best of luck with your investing.
Perfect. Thank you, Michael. Thank you very much. Thank you all of you for listening and taking some time to hear me.